Ever feel like Zillow's Rosy housing forecasts don't match what you're seeing in your neighborhood? You're not alone. I've been digging into their latest report, and what I found might surprise you. The numbers tell a different story than the headlines. In this video, we dissect Zillow's latest housing market update. We juxtapose their upbeat projections with concrete data on inventory, affordability, and market dynamics. By the end, you'll grasp why their optimistic view might not reflect your home buying reality. Are you prepared to explore the actual state of the housing market? Let's examine Zillow's latest forecast. They project a 2% increase in home values for 2024, which is pretty sane for the housing market. But before we get too excited, we need to examine the numbers behind the rosy outlook. Zillow's recent report suggests a stabilizing market, with home prices expected to rise modestly over the next year. Their graph shows a gentle upward slope, indicating steady growth without dynamic spikes or dips. This forecast makes it sound like the supply and demand dynamic in the housing market has been fully restored. But here's where things get interesting. A different picture emerges when we contrast this forecast with current market realities and affordability challenges. We're seeing record high home prices in many areas, coupled with interest rates that, while they've come down from their peaks, are still significantly higher than buyers saw just a couple years ago. So, what assumptions is Zillow making in its forecast? It's likely factoring in expected economic growth, inflation trends, and stability in interest rates. It might also consider demographic shifts and migration patterns that could impact housing demand in certain areas. But the focus of this report is on the overall U.S. housing market. However, there's one major factor that Zillow may be overlooking or downplaying in its analysis. This report highlights several crucial data points, and if you stay with me through each one, you'll reach a conclusion that's easy to understand. As we examine the data, discrepancies emerge between Zillow's forecast and current market trends. While Zillow anticipates modest growth, many regions continue to experience historically low inventory levels. This imbalance between supply and demand may cause greater price volatility than Zillow's projected steady growth suggests. If you've been following me for a while, you know my experience has taught me that informed consumers save money and are happier during their move. That's why I often use available data to assess U.S. housing market conditions. If you're not a subscriber, please click the thumbs up like button and subscribe now so that you get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to learn the tips and tricks that put extra money in your pocket, then subscribe now and I'll keep you in the know. While regional differences are significant, there's another factor creating a divide in the housing market: mortgage rates. Recent fluctuations have given some buyers a $40,000 advantage, but they've also trapped others in their current homes. How is this mortgage rate roller coaster reshaping the entire real estate landscape? Let's take a closer look at mortgage rates and their impact on both buyers and sellers. Currently, rates are about 21% lower than the 50-year average. However, we all recall that rates were less than half of that just 3 years ago. Recently, there's been some relief. In September, rates dropped, providing buyers with a notable increase in purchasing power. According to Zillow, this decrease gave buyers over $40,000 more purchasing power compared to May, but has been a game changer for those hesitant to enter the market. But here's where it gets tricky. The mortgage market has been far from stable, with rates fluctuating and even spiking after a strong October jobs report. This volatility has led to some interesting market behaviors. On one hand, lower rates are motivating both buyers and sellers to re-enter the market, bringing us closer to pre-pandemic activity. On the other hand, it's triggered what's known as the interest rate lock-in effect. You might be wondering, what's the interest rate lock-in effect? Picture this: you purchased your home a few years ago when mortgage rates were at record lows. Now, even with recent rate drops, today's rates are still much higher. If you sell, you'd have to secure a new mortgage at these elevated rates. For many homeowners, that's a deal breaker. They're opting to stay in their current homes to keep their low rates, which is tightening inventory in many markets. This rate volatility isn't just affecting individual buyers and sellers, it's having broader impacts on the market as a whole. For instance, with rates recently jumping from 6.1% to 6.6%, we're seeing less overall market activity. Now, you might be wondering, but isn't a strong jobs report and rising wages good news? The answer is both yes and no. While a strong economy is typically a positive sign, it's also driving these mortgage rate fluctuations. Solid economic data impacts the Federal Reserve's interest rate decisions, which directly affect mortgage rates. It's all linked together. So, what does this mean for the long term? We could be looking at sustained volatility in the housing market activity. This has potential impacts on buyer demand and affordability that are hard to predict. We're already seeing signs of this in the decline of new listings and the increase in price cuts. It suggests that while buyers are returning to the market, sellers are still trying to figure out how to navigate this new landscape. While the existing home market grapples with volatility, new construction tells a different story. Builders are making a needed pivot that could transform neighborhoods across the country. But is this shift a solution to the affordability crisis or just a band-aid on a deeper wound? Let's take a closer look at what's happening in new home construction. Builders are in a difficult position. While there's a clear need for more housing to meet demands, rising costs and affordability challenges are making it harder to build and sell standard single-family homes. So how are builders responding? They're getting creative. In 2023, we saw a significant shift in the types of homes being built. While single-family home starts dropped by 7.1% compared to 2022, something interesting happened with attached homes. Construction of townhomes and other attached single-family units actually increased by 3.2%. And get this, new condo starts jumped by 8.1%. That's a pretty significant change in strategy. Why the sudden love for townhomes and condos? It's all about maximizing land use and keeping costs down. With land prices skyrocketing, builders can squeeze more units onto smaller lots. In fact, the median lot area for new homes shrunk by 700 square feet in 2023 compared to the previous year. That's a lot of space savings. But here's where it gets really interesting. Despite this shift towards higher density housing, overall new home construction is still down. In 2023, construction began on 946,000 single-family homes. That's 16.5% lower than in 2021, and 2024's numbers look to be even lower. So while builders are adapting their strategies, they're still not keeping pace with the growing demand for housing. This trend is having major long-term impacts on the housing supply. If builders continue to focus on higher density housing, we might see a gradual shift in the makeup of American neighborhoods. More townhomes and condos could mean more affordable options for today's buyers, but the high cost of construction means they're delivering smaller homes for yesterday's single-family detached home prices. Here's the crucial point. Even with this decline in new construction, we're still building more homes than before the pandemic. In 2023, about 11% more single-family homes were completed compared to 2019. But is it enough? With estimates suggesting we need millions more homes to meet demand, on top of the number of homes we need to build annually, this modest increase might not be moving the needle fast enough. As we dig deeper into the data, a troubling question arises. Is Zillow severely underestimating the scale of our housing shortage? Zillow's Market Heat Index points to a cooling market, but alternative analysis suggests we're not just short a few million homes. We could be missing 15 million or more. The implications for buyers, sellers, and the entire economy are staggering. Let's take a closer look at Zillow's Market Heat Index. This measure aims to gauge the balance between supply and demand in the housing market. According to Zillow, we're approaching a more neutral market condition. They're seeing signs of cooling demand and increasing supply, which sounds like good news for buyers struggling in a highly competitive market. But here's where things get complicated. When we compare Zillow's assessment with other analysis of housing supply, we see some significant discrepancies. Take Kevin Erdman's research, for example. His analysis suggests that the U.S. isn't just a little short on housing. We could be lacking 15 to 18 million homes. That's a far cry from Zillow's more balanced market picture. So, why such a big difference? It all comes down to methodology. Zillow's Market Heat Index focuses on current market activity, things like active listings, days on the market, and price cuts. It's a snapshot of what's happening right now. However, Erdman's analysis takes a longer view, looking at historical building trends, population growth, and changing household formation patterns over decades. This methodical difference isn't just academic, it has real-world implications. If we're truly short 15 million or more homes, that suggests a much more severe affordability crisis than Zillow's data might lead us to believe. It could mean years, if not decades, of continued upward pressure on home prices and rents. Take a look at this housing supply and demand graph. Zillow consistently reminds us that the supply of homes for sale is increasing, but in context, it remains far below where it needs to be. The housing shortage is real, and Zillow should do a better job of comparing now with the past. Here's what Zillow isn't saying. The current supply and demand numbers show fewer than 4 months of supply of homes on the market. In a balanced market, we'd expect to see about 6 months of supply. And get this, today's inventory levels are still 66% lower than the peak of the market in 2007 and 37% below the historical average. These numbers paint a picture of a market that's far from neutral, despite what some indicators might suggest. The potential consequences of underestimating our housing shortage are significant. We could see continued affordability challenges, a rise in homelessness rate, increased competition for available homes, and even broader economic impacts as housing costs consume a larger share of incomes. The dream of homeownership might be increasingly out of reach for younger generations. So, what's the real story behind Zillow's housing market update? While their data is solid, their conclusions might paint a rosier picture than what many of us are experiencing. We've seen how mortgage rate volatility, shifting construction trends, and a hidden housing shortage create a complex market landscape. The big question is, why might Zillow downplay the severity of the housing crisis? Are there industry pressures or business interests at play? A more active housing market will bring more visitors to the Zillow website. All of us must look beyond the headlines and dig into the data ourselves. Next time you read a real estate report, don't just take it at face value. Compare it with other sources, look at local market conditions, and consider long-term trends. By doing your own research, you'll be better equipped to navigate this challenging market and make informed decisions about your housing future. Selling a home has changed dramatically due to the immediacy of digital marketing and social media. Even amid my career's strongest sellers market, I continue to see sellers leaving money on the table. Don't let this happen to you. Check out this popular video featuring my top 6 home selling tips for 2024 and beyond.